What's up, traders? In this video we will be speaking about multi-time frame analysis. We'll be going in depth on how you're supposed to use multi-time frame analysis to gain an edge in the market over your competitors. We will be taking a specific example, the USD CAD trade we are in with all the students, and we'll be breaking it down from the monthly to the 4-hour time frame, giving a lot of education along the way. If you're new to the channel, I would like to welcome you. I'm a top author on the TRADINGVIEW platform, and I'm mainly a swing trader and I trade Forex. Without further ado, let's get in the market. So let's see how multi-time frame analysis can give you an edge in the market. So again, let's take an example of a pair. Let's break it down by using multi-time frame analysis, and let's see how everything will combine in the market to give you the edge that you need. So here on the monthly time frame, the first thing you're supposed to ask yourself is where is the market going and what kind of patterns are we creating? Are we in a support or resistance area? And what kind of legs in the market we're expecting. So are we expecting a push to the upside to complete a certain pattern, or are we expecting a push to the downside to complete a certain pattern? So here from the monthly, we can see that we have a pattern inside a pattern, and the pattern we have is a bearish W. What do I mean by a bearish W? A bearish W is a variation of a channel. It's basically the pattern that creates a channel. So you have a push to the downside, then the market makes a retracement, and the market creates a lower high, and then the market makes a lower low, and again the market retraces. So basically what you have with a bearish W is a high, a low, a lower high, and a lower low. And after this lower low, the market made a retracement. Now at this point, what you're expecting is the market to make another lower high around this area and make the last lower low. So basically completing this channel. This is what you expect from a bearish W. Now in this particular situation, you have a pattern inside a pattern. Why? Because you have one first big bearish W here and another small bearish W here. Now you can see that in both these scenarios, so both on the big one and on the small one, you have the creation of a high, low, a lower high, a lower low, and you expect the market to create a lower low and make continuation to the downside. And as you can see, also here on the smaller one, what you have is a high, a low, a lower high, a lower low, and again a lower high, and you expect continuation to the downside to complete this pattern. So zooming in here on the most recent price action, let's see what kind of price action we're getting, what kind of other confluence factors we have. The first thing that you have to realize is that the most common pattern in the market is an impulse correction pattern. So basically you have the impulse, you have a correction, and you have again an impulse. Or to the downside, you have an impulse, you have a correction, and again you have an impulse to the downside. Now in this particular situation, what you can see is that the market started here, made the impulse, made the correction, and you're expecting continuation to the downside for another impulse. Now, how are you supposed to have basically information on this retracement? The easy way to do it is by simply using your Fibonacci levels. Why do you use your Fibonacci levels? The Fibonacci levels will give you the strong areas in the market in which the market is supposed to basically find strong support or resistance. So for example, you have an impulse to the upside and you want information on this retracement, meaning you want to have strong areas that the market will encounter when it will make the retracement, or in other words, strong areas that the market will likely shift away from and start the next impulse to the upside. So what you do, you take your Fibonacci from the low to the high of the impulse leg, and you expect the market to shift away from one of these areas. So to reject one of these areas, either the 0.382, the 50%, 0.618, 0.786. Now the 50%, strictly speaking, is not a Fibonacci level. It's simply 50% of the impulse leg. So going back to our live chart, if we want basically information on this retracement, you need to take your Fibonacci on this impulse. So let's take our Fibonacci from this high to this low. And as you can see, the Fibonacci level that the market is rejecting is the 0.618. In other words, the golden ratio, because as you know, 0.618 is the golden ratio, meaning that most of the times the market will reject the 0.618 before starting the next impulse to the downside. Very important to say this. Most of the times the market will hit the 61.8 of the Fibonacci taken on the impulse leg, because in this where you will have more basically precise information on the retracement before the next impulse to the downside. So again, we have double confirmation from a pattern perspective, again because we have a bearish W, from a pattern perspective because we simply have impulse correction and again an impulse and we expect continuation to the downside, and also from a Fibonacci perspective we have a rejection of the 61.8, or in other words of the golden ratio. So dropping down on the weekly time frame, let's see what kind of confluences we're getting from a weekly perspective. Now here from a weekly perspective you can see that again we have, starting from this high, the first impulse to the downside, then we have a retracement, and we're expecting continuation to the downside to create a lower low. Now if we want information on the retracement, basically we need to take our Fibonacci on the impulse, as we have already said, on the monthly time frame. So taking our Fibonacci from the high to the low on the weekly time frame, you can see that the market has basically rejected the 78.6 twice, and now the market has basically broke below the 50% and already retested it this current trading week. So everything at the moment also on the weekly is pushing to the downside for the completion of this pattern. Now what can we get more from the weekly time frame? What we can do is move to a line chart. Now what a line chart will give you is basically the closest in the market. You can see these edges here are the closest in the market, or in other words the weekly closes. Now the weekly closes are very important and act as extremely strong areas of support or resistance. In this particular case, since the market was coming from below, the market had found extremely strong resistance at the area, and you can see how precise they actually are. The market rejected precisely that level, and it's no surprise, it happens over and over again. Now continuing with our analysis, since you know that you're basically noticing up to this moment that from the monthly and the weekly we have taken a lot of confluence factors, and now by going on the daily we will get even more confluence factors. So let's go on the daily. On the daily time frame, what you will see is that pretty simply the market created this M formation, and as you know, after an M formation you expect a retracement at least to the 382. So basically after this impulse to the downside you expected a correction, and the correction came. So what you're supposed to do is take your Fibonacci from the high to the low, and the first thing you immediately recognize is that the 382 is in perfect confluence with the close we had found on the weekly time frame. If you remember, this black horizontal ray here is exactly the close that we had found on the weekly time frame. So the reason for which the market rejected this area so aggressively is because you have the confluence of the 0.382 Fibonacci and the weekly close we had found. Now dropping on the 4-hour time frame, that is the time frame on which you will take your entry, and that is the reason for which we shorted this pair with the students and the members. Why did we short it? The simple reason is because we simply have a very strong resistance area here. Let me explain better. Let's use the replay mode. So the first thing you need to realize, you see that the market is consolidating around this area. Now there are some particular things that I can't tell you. When the market is shifting from a bullish or a bearish environment, we have a lot of rules to determine that I can't show you in these videos. But what I can speak about is simple market structure and price action. So let's take it only from a simple market structure and price action, because if I had to speak about all my rules, then it would basically take a lot more than just this video. So here on the 4-hour time frame, at the moment, what do you have here? You simply have a consolidation period. So after consolidation, there are two things that can happen. Overall, we know that the market is supposed to push to the downside, but since we are in a consolidation period, we still don't know if the market will push to the upside or to the downside. If it will push to the upside, then we have a possibility to short this pair because at this area we have previous support, turn resistance. But at the moment from here, you have no clue if the market is supposed to continue to the upside or to the downside from a structural perspective. That is the moment in which you get your edge also in the 4-hour time frame, because now also the 4-hour time frame from a strictly structural point of view is also on your side. So what you're expecting at this point is a simple retracement inside of this area before continuation to the downside. And I'm speaking about only a simple price action perspective. I'm not incorporating all my rules, but from a simply basically price action perspective, you expect a retest of this area before continuation to the downside. So what you can do, you can simply take the area, your entry here, put a stop loss above, and wait for the market to retrace inside of your area. And you don't even need to monitor price action because you already have a limit order there. Now, as you can see, the next candles, basically during the Asian session, the market started the retracement, went for the entry, reacted one time. Now, what happens when the market creates this? After this, most retail traders, instead of placing their orders here together with the banks, they will wait for this candle to come, then they will take their entry here, put the stop loss here above. Their entry will look something like this. And I promise you guys that many people will do this. They see this in bearish engulfing, they just put their stop loss there above, and look what happens. The next candle takes them out, and then you get the continuation to the downside. That is how market makers are hunting your stop losses. Don't be like the masses. Trade together with them. Put your entries together at their levels. If you know where the market is supposed to create their swing points, then you will have a crazy risk reward, much better than the retail side of the market, and you won't be affected by stop loss hunting. Also, let's speak about our take profit. We never spoke about the actual take profit. Now, take profit is obviously taken on the monthly time frame. There are two take profits, one on the monthly and one on the weekly time frame. So the monthly take profit, we will just take our Fibonacci from this high to this low, and minus 27 will obviously be our target. On the other side, this will be the monthly target. What about the weekly target? The weekly target, the previous leg will be our Fibonacci from this high to this low, because again, if we want information on the leg to the downside, we need to put our Fibonacci on the previous leg. So the target from the weekly time frame will be here just above the minus 27. So as you can see, by applying a complete multi-time frame analysis, we have everything we needed. We have our entry area, we have our take profit 1, and we have our take profit 2. Basically everything we need, and we used all the time frames to determine it. So as you can see, you have your first take profit around this area for a 1 to 5 risk to reward, and you have your take profit at the second area, so basically the monthly take profit, for a 1 to 12 risk to reward. And these risk to rewards, you will never have them if you're trading with a retail mindset. So you have the first one here and the second one there. Now we are already obviously risk free on the trade. Our stop losses are already break even. Let's see if the market will continue to the downside. If not, we will just be out of the trade break even. But what is the most important thing? The most important thing is that overall, if you keep positioning yourself in these situations, so with a high risk to reward, at least 1 to 3, you only need to be right 3 times out of 10, and you will still be ahead of the market and in profit. And that is the real holy grail of forex trading. So always position yourself with at least 1 to 3 risk to reward, and you need to know well how the market works to be able to do so. I hope you enjoyed the video. If you did, make sure you smash that like button. You might think it's not really relevant, but it does actually support the creation of more content just like this, completely free and highly educational. So make sure you smash that like button and let me know in the comments below that you actually enjoyed the video, and I will see you in the next video. But make sure before you leave to click on the link below and basically take your free training that is available directly on the link below this video. I will see you in the next video.